Hey guys, did you know that you can buy and sell a stock at the same price and then still make money? Here's what I mean. So this is a chart of Google. As you can see on the right hand side, right now it's $107.90. So what I'm saying is that you can buy at this price, $107.90, and then sell it again at this same price and then still make money, right? So you might be wondering how it's done. Well, you can do this by using the options wheel strategy, right? And I coined this the ultimate income generation machine because that's what you're really doing with this strategy. This is a premium selling strategy where you're selling options. So you can keep selling this over and over again to collect this premium. Okay, so here's how the options wheel strategy work. So we always start off by selling a put option with the intention to buy 100 shares. So this is what is called a cash secured put. Now I've created an extensive video all about this. So if you want to go and watch it, just go ahead to my channel and you can see the videos on cash secured put. But basically, when you sell a put option, you have the obligation to buy 100 shares of the underlying stock if you get exercised. So for example, if we sold a put option at the strike price of, let's say, $50, and if the stock closes below $50 at expiration date, then you have the obligation to buy 100 shares at this $50 price. Alright, so once you are already long these 100 shares, the next step is to then sell a call option to sell away those shares. Now this is what is called a covered call, and again I have many videos on the covered call. You can just go ahead to find them and watch them. But basically, when you sell a call option, you now have the obligation to sell 100 shares of the underlying stock if the option gets exercised. So for example, we now have sold a covered call at $50. So if the stock was to go above $50 and it closes there at expiration, then now you have the obligation to sell away the 100 shares at $50. So that is how the wheel strategy works. So I'm going to give you a few steps. So step one, we always start off by selling a cash secured put. All right. By selling a cash secured put, we will receive a premium. And then the next step is to see whether we get assigned on the cash secured put, right? If we are assigned, we get the 100 shares. But if we are not assigned and it expires worthless, we just simply go back to step one and then sell another cash secured put. And we keep selling the cash secured put until we finally get assigned on that put, all right? So once we have been assigned the 100 shares, the next step is to sell the covered call. Right, so once you sell the covered call, again, we just have to wait to see whether the covered call gets assigned and our shares get called away. If our covered call does not get assigned, all we have to do is just keep selling another covered call, and we keep doing this until the shares get called away. That means our call options get exercised. So as you can see, this is why it's called the wheel strategy, because we are just doing the same things over and over again to generate income, right, over time. So I want to give you a visual illustration so you can see exactly how it works. So let's say, for example, we want to sell a cash secured put at $112. So this is the strike price that we want to sell at. So when we sell this cash secured put, let's say we receive $2.50 for it, right? In premium, this is $250 into our account. Now the next step is simply to wait to see where it expires, right? Does it expire worthless, or do we get a sign on it? So let's say the market comes down below our cash secured put strike price, and then at this point in time, we are now assigned. So if we are assigned, we are long 100 shares at $112. So what is the next step? It is to sell a covered call. So we sell the covered call at the price where we long 100 shares at. So again, by selling this covered call, we receive another premium. So let's say we receive $2.50 for this. So it is $250. So at this point in time, we already collected $500. And all we have done is just buy the shares at $112. The stock hasn't even moved in our direction yet. And we are already collecting $500 for that. So the next step is just to simply wait to see if the stock goes up to get our shares assigned, have it called away, or if it expires worthless, then we sell another covered call. So let's say on this date, the option expires and the stock is above our strike price. So at this point, our covered call is assigned and our shares are called away. So at this point of time, we no longer have the 100 shares. So we no longer have a position. So what we have to do is simply sell another cash secured put. So again, we sell the cash secured put, and let's say again we receive $2.50 for it. So by this time, we have now collected 3 of this $2.50. So that is a total of $750. So then we wait and see whether we get assigned. So in this case, the market did come down, right? And then we have been assigned another 100 shares, right? So now we are long 100 shares again at $112. So now that we are long 100 shares, what do we do next, right? You know the drill. We just simply sell another covered call. And again, we sell the same strike price and we collect $2.50. So we have now collected $1,000 in premium just by selling the cash secure put and the covered call. So let's say on this date, the stock finally is above $112 and our covered call expires. This is our expiration date. So we are now assigned and our covered call, our shares have now been called away. Right, so at this point in time, again, we have no more positions, so we just rinse and repeat. So we sell the cash secured put again to initiate the wheel all over again. So as you can see, this is really like an income generating machine. You're just selling this cash secured put and this covered call to keep collecting this premium. Now you might be asking, Davis, can you actually sell the covered call at say $116 or $120? And the answer is definitely yes, right? You can sell the covered call anywhere you want. So if you were to sell at $116 and the market was to close above this strike price at expiration, then it means not only did you collect all this premium, but you also gain a capital gain of $4 per share since you have longed at 112. And then your shares get called away 116. So this is $400 in total for 100 shares. So you receive $1,000 in terms of premium and you receive $400 in terms of capital gains from your stock. Now you might be wondering, this options wheel strategy sounds a little too good to be true. Are there any risks? And yes, there are some risks and you want to be aware of it. Now the biggest risk with this options wheel strategy is that you sell the cash secured put, alright, and then you get assigned on it, and then the stock never goes back up to the price where you bought the stock at, right? And imagine if the stock just keeps going all the way down. So this is a big risk because by then you will be long 100 shares, which is $13,600, and then the premium which you have received for selling this would not even come close to covering the amount which you have put into the stock. So if it takes forever to finally go back up, then your money is actually stuck in this stock. Right, and if it never goes back up, then you are in a loss. So how do you mitigate this risk? How do you make this option wheel strategy a little bit safer? So I'm going to share with you a few tips on how you can make the options wheel strategy safer. By the way, if you're enjoying this video so far, do subscribe and hit the thumbs up button so I can create more videos like this for you in the future. Alright, back to the video. So the first tip is to ensure that you have enough funds to get assigned 100 shares, right? So if the stock is $30, then 100 shares would mean that you need $3,000 to fulfill this purchase of the 100 stock. Now there are some people who maybe only have $1,500 in their trading account, and then they still go ahead to do the wheels option strategy on a stock that is $30. So what happens is that they are trying to utilize margin. That means they trade on margin. You can't do that, but what happens is that when you're on margin, what actually is happening is that you are borrowing the other 50%, the other $1,500 from the broker. And when the broker lends you this money, they actually charge you an interest rate. So as you can see, this is the interest rate depending on your account size. So if your account size is under $10,000, you'll be charged a pretty hefty 11% on the borrowed money. So if the stock takes a very long time to finally recover back to the price which you bought it at, then this 11% can really amount to quite a bit, because this interest down here is accrued on a daily basis. So you're actually being charged a financing charge, a margin charge every single day that you're holding on to the stock. So if the stock takes, let's say, years to finally go back up to your strike price, to the price which you bought at, then you'll be charged quite a lot of money by the broker, right? And then your premium which you receive may not even be enough to cover this margin charge. So as always, for myself, I always prefer to have the full cash to be assigned the 100 shares. So if the 100 shares is going to cost $3,000, I'm going to ensure that I have $3,000 before I go ahead to do the options wheel strategy. Now the next tip is to wait till the stock is oversold before selling the cash secured put. So what do I mean? So overbought or oversold is basically an indication by indicators. So there are indicators, like this is the stochastics oscillator. So what it does is that it tracks whether the stock is overbought or oversold. So you can see that there is this blue squiggly line down here, as well as two purple lines. So if the blue line was to go above this purple line, it would indicate that the market is overbought, and if it goes below this line, it will indicate that it's oversold. Now what we want to ideally do is sell the cash secured put only when the market is oversold. So this way we know that if the market is oversold, there's a higher chance for the market to rebound back up soon after, right? So as you can see, there are a number of instances where the indicator stochastic says that it is oversold, and then the market subsequently goes back up. You can see this is oversold, market goes back up, and at a time when it's oversold again, market goes back up, and at times oversold, and the market goes back up, right? Now one thing to understand is that this is not 100% working all the time, right? It's not like every time the indicator is showing an oversold, right, indication, that the market will always bounce back up. The thing is that there's a higher probability that it will bounce back up than it will go back down. So it's much better to sell a cash secured put when it's oversold than if, let's say, the market is overbought, right? So if the market is overbought, it means that there's a higher chance the market will subsequently go back down rather than go back up. So if you're selling a cash secured put, and let's say you're going to get assigned on the shares, you want ideally the market to go up after that, right? And the better way for you to do that is when the market is oversold rather than when it's overbought. So we want to be more strategic and smarter when we are trying to sell our cash secured put. The next tip is to sell the cash secured put below a support area. Now, if you're not familiar what a support area is or support level is, it basically just is a place on the chart where, you know, the market has difficulty going below. So as you can see, this is the previous low. So you were to just draw a line down here, right? You can see that the market has trouble trying to go below this, right? It tried to break below this low, but then it couldn't, and then it subsequently goes back up. So these are places that you want to look out for on the chart as well to see where it could be a good level to sell the cash secured put, right? To initiate the options wheel strategy. So here's another place, right? You can see that this is a resistance. You can see the price had difficulty trying to break up, trying to break out of this area, and finally it broke out. And then this resistance area sort of became a support area. You can see that the price went up and then it started to bounce off this quite a number of times. So this can be a good area to say that, hey, you know, there's some support here. I want to sell my cash secured put below this area. So we can see on the right hand chart, this is slightly oversold. It's going to the oversold territory. So what we can do is that we can identify this as a support area, and then we could sell a cash secured put below this area. Maybe you can sell at 163, maybe even lower 160, depending on how much premium which you can get. So as you can see, this is much smarter than if you were to just sell a cash secured put anywhere you want. Now the next tip is to avoid choosing stocks just for the high premiums and to choose only fundamentally good stocks. So there are a lot of stocks out there that gives very high premiums because they have very high implied volatility, and there are a lot of traders that are trading this sort of stocks because if they give you a juicy premium, then it means that you can make much more on your covered calls and as well as your cash secured put. Now the problem with this kind of stocks is that they may not necessarily be a fundamentally good stock. That means that it could be high volatility, gives you high premium, but the stock could not go up in the long term, right? So for example, if you take a look at these two companies, right, this is the income statement for company, right? Let's say this is company A, this is company B. So if you were to take a look at company A, the revenue is the blue bars. You can see that it's pretty inconsistent. Certain years is, you know, high, certain years is low. Basically, it's not increasing at a very nice rate which we want. And you can see that the bar in yellow indicates that it's not making money at all, right? The net income is negative for the past 5 years. It's not making money. Whereas on this side of this company, company B, you can see that the revenue is increasing over time and the net income is positive as well. It has been increasing over the past 5 years. So if you were to do the options wheel strategy, would you rather do on company A or would you rather do on company B, right? You definitely want to do on company B, because if a company is making money and is continually making money over the number of years, then you will know that it has a good chance of the stock always going up in the long term. So what is these two companies? As you can see, company A is GameStop and company B is Google, right? So you see a lot of traders, they are actually trading GameStop because it's giving a very high premium. Now you can definitely trade that, but if you want to do the options wheel strategy, you ultimately want to go do it on a stock where the market will go up in the long term, because if it doesn't go up and your cash secure put, or the place where you buy the stock at, the stock doesn't go back to that point, then you will not be making any money on the options wheel strategy, right? So it will be safer to do on fundamentally good stocks. Now the next tip will be to choose broad-based index ETFs, right? Like the IWM, which is the Russell 2000. You have the triple Qs, Spiders, EMXLF, and etc., right? So the thing with individual stocks is that it can easily be affected by many things that happen, right? Let's say, for example, if the stock changes its CEO or something happening with the company that changed the business direction, the stock can really be affected. It can crash, right? But whereas for an ETF, it holds a basket of stocks. So when it has a basket of stocks, the chances of it actually going to zero is lesser. For example, back in 2008, there was these two stocks, Bear Stearns as well as Lehman Brothers, right? They went bankrupt during the 2008 financial crisis, right? And if you had did the options wheel strategy on both of them, then sad to say that you would have lost all your money. But if you do the broad-based index, like all of these ETFs, even though that during the 2008 financial crisis, the market did go down, but the ETFs eventually did recover, right? So if you did the options wheel strategy on them, you would eventually make money, right? So for example, this is the ETF, the XLF ETF. It tracks all the financial stocks in the market. So back then, 2008, Bear Stearns and Lehman Brothers, if I'm not wrong, they were also included in this ETF. They were part of this ETF. So while it did crash, right, it ultimately did go back up again. Whereas for Bear Stearns and Lehman Brothers, they went to zero. So if you want it to be safer, you want to trade the options wheel strategy in a safer way, then it would be probably better to do it on ETFs. Now you can see that if you were to sell a cash secure put, let's say right at the high, right around 2007, you will see that it takes quite a long time before the market goes back up again, right? From this point of time when the market crashed all the way to where it finally recovered, it took over 10 years, right? It took over 10 years. So one way to mitigate this risk is to split your entries into tranches, and that is the final tip for making the options wheel strategy safer. So what do I mean by splitting them into tranches? So basically, let's say you have enough cash to sell 3 cash secure put, let's say at the $30, right? So that means you need to have a capital of $9,000. So let's say instead of just selling 3 cash secure put all at this one level, you split them up into 3 different levels. So maybe you could sell one at the $30 level, sell another one at $25, sell another one at $20. So this way, if the market was to really go down, right, you would be able to average down your price. So it makes it easier for you to break even on your stock and then make money on all the premiums which you sold, right? All the cash secure put as well as the covered call. So this way it's much easier to break above 25. So if you were to, long 100 shares at each of this level, your average would be 25. So it'll be much easier for it to go above $25 than it is, to go above $30. Okay, that's it for me, guys. I hope you enjoyed this video. If you have, please subscribe and hit the notification bell so you'll be informed whenever I release a new video like this. And as always, thanks for watching. I appreciate your time and see you in the next video.